Good evening, Nick Inman here from VolumeProfileTrader.com on Thursday, May 10th, and the S&P, not gold, but the S&P, well, really what you should have been expecting for it was a bounce and something more than what we got. And right now this red box, you can see that's after hours, but just focusing on today's price action, the morning started good in terms of where we were, but it didn't really do anything. Okay, so here's a weekly chart, a 1 week chart I should say, and the market opens up, and it opens up above yesterday's high. It looked positive. The only thing we were really going up against was Tuesday's high, and then it would be off to really, I guess you could say, close the gap. But instead, we traded sideways for nearly 45 minutes, and then the trend started to the downside. We held yesterday's point of control. Okay, I changed it to daily profile. So we held yesterday's point of control right here at this 52 level. We got down close enough, started to reverse. Had two trades to the long side that would have worked out. The second time was probably a little more doable. So, here we are back at the highs, and what happens? We roll over and actually press new lows for the day. And after hours, we're back below 1350. So despite the market closing originally at 1357, we're about 10 points lower than that, and that's because of the JP Morgan situation. So I think the chart that tells the best picture, to be honest, is looking at, I have a 180-day 4-hour chart, and remember, using volume profile, the point of control is telling you where the strong move in that time frame is going to come from. And looking at it right here, right now, let me zoom out just so you can get a better glimpse of how the volume is shaping out. What happens when we go sub 1338? Alright, look at price. Price has bounced every time, anytime it's come close. And look at the volume. What happens after 1338 or below 1338? There is, practically no volume until 1310, and from there you make the argument for about 1260. Let's call it 1260, 1262, 1263. That's about break even on year. This market, unless if it can get above this point of control 1363, which surprisingly enough today 1363.75 was the high, and the point of control is 1363. So a failure to even test that, or I should say to just test that once today and fail, and now we are 15 points off of that level, despite the fact that the news from JP Morgan shows you that there is weakness in this market, and it is probably going to roll over on this JP Morgan news. You need to be very careful. If you are net long this market, you're putting yourself in a situation where you're going to lose some money if this market rolls over, and there's really no reason to do that. What you can do is basically sell some stock at the upper end of this range, or and when I mean upper end of this range, I'm talking about possibly down to 1200 on the S&P sort of thing. Looking down, say 1250, you have a potential of 100 points or more of downside in the S&P, and there's no reason to hold stock up at these levels if you can just buy it back 10% lower in a couple of months or whatever the case may be. Now, if the market holds these levels again, it needs to recapture 1363. If it does that, if it holds that, especially into a close, I think that you rebuy this market. But this looks ugly, and this looks like a market that can't get above the top end of this range. So maybe it's a situation like it was a couple of weeks ago, where the market was just trading in a fairly tight range for a period of time, and then it broke out semi to the upside. Maybe that's all we need. But the fact that we're sitting, just last time we were sitting 1360, this 1360 level was support. Now it's resistance. We fell from practically the highs down to new lows relative to this range. Here, I'll zoom in so you can see it better. So we made new lows relative to this range. So not only did we do a fake out, but we made new lows. That is ultimate rejection. So support becomes resistance. It's hard to make an argument to not sell this market, and I think that you can have a fairly decent target to the downside. Now, I'm not saying pile in on one day, but at the same time, you look at what's going on, and obviously some names have already been rolling over. Normally the S&P is the last to roll over, at least in my perception. So just be careful. So JP Morgan trading down around 38 after hours. That's obviously not good news for the market. The entire bank sector is trading down. 38. It does put you at an interesting level. You're near the 200-day moving average. You're near what was resistance. Was a bounce area for a while, and then we broke out. So you could see a little bit of a bounce here, but in all honesty, is this really where you want to put money? I have to say no. It's really not even worth it. Not unless if we get an extreme sell-off. To put it better, here is the after hours, and you have volume 38. Let's see, 38, 32 or so, down to 37.17. You have some pretty good volume here. What was resistance should be some type of support. I'm sure if you do some type of Fibonacci retracement, it has some special number to it. Say 50%, 38.2. We're in that pullback zone. I'm not saying that JP Morgan's worth this risk, but realize where it is, and maybe for a short trade, if you get a bounce here, you can trade a $2 range back to the upside, but I would be very limited in that. Gold, just watch it. Value area low for the year. Draw a line at these lows. At these lows, was it right to be a buyer or seller? I think it's pretty clear that it's right to be a buyer. So just watch for it, and at least watch for a bounce. I know I went from covering my short on gold yesterday to going long, and I took that position off too. So I went from, what the original position was to hedge my longs. I did that. It worked out successfully. I took profits on those hedges. I felt like gold, yesterday morning, it had a nice bounce in the morning pre-market, and I thought this is probably a cheap shot to go long gold with an expectation of, I was really looking for about 1610, but we didn't get there. We got to around just under, actually I think we got above 1600 for a brief period of time today. But that's all I was looking for, was an oversold short-term bounce. We got it, in two trades, one to the short side, which was a 156 by 154 put spread on gold. That ended up, I sold out of that for, I want to say 50% profits, and then today, the exact opposite, the 154 by 156 call spread, I sold out of it for about 35% gains or so. So not bad for a 2-day, turnaround. But it just shows you that if you are very in tune to the market, you can make very sound trading decisions that make a lot of money. And situations like that, where you're pretty much I wouldn't, guaranteed isn't the right word, but the probability of getting a short-term bounce off of a key area, it's kind of the least the market could do, sort of thing. Shorts are going to look to cover there, so it's really an easy trade, I guess, is what it boils down to. Okay, I remember recommending Caterpillar a couple of days ago. Let me get out of this all these drawings. All right, Caterpillar's point of control, I think it was in this 105 area, and just because it had the most volume. After a couple days of trading, the point of control is now at this 95 level. Just take note of that. After what I just talked about with the S&P, obviously I'm not very positive on the market. So Caterpillar should be something that hopefully you can get it around this price to sell tomorrow, which would probably put you right around a break even. And it never broke below the 8's intraday low, which, as I said, where you want to have your stop. But yesterday it was positive for a brief amount of time, and then it originally opened lower back at the lows, didn't make a new low, and traded higher, went positive for part of the day and closed lower. Today we have a higher low, but the high is just around the same. Regardless, you keep your if you're still willing to be in it, you keep your stop below let's see, this is 93.92, which has to be the low. So keep it below 93.92. I would suspect that we're going to see 93.92 on Caterpillar. So if you can get it at a higher price, it'll probably be worth it. Apple, I just want to explain another example of how a call spread, or how you can use the short-term moves in your favor to make some money. So Apple yesterday had, we have 3 consecutive days at the bottom end of this range. That makes about 5 or 6 total, and we closed in the upper half, generally speaking, of this range yesterday. So what do? Before the market closed, I buy the 570. By 575 call spread expiring Friday. I think I paid below. It was below. I remember it was below half the spread. It was like 220, 225. It traded as high, if I recall, as high as $4 or so today, in terms of the profit on it. And I ended. You take these kind of spreads, you take the dollar, and you take the dollar run sort of thing, and that's exactly what I did. I mean, literally, when Apple hit 575, I yanked this position off, and sure enough, today the high was 575.88. So those small trades where you're not going for a home run on the stock, but you're just looking for a quick flip. These are those type of trades that work out, and you can do them on a name like Apple, where the spread of the options, which in Apple they're $5 in width, a 1% move in Apple is more than that. So it's not uncommon to get a $5 move. So if you're looking for these swings, this is a great way to play it, and you can do it. Gold, it's the same situation. A 1% move is less, is more than the width of the option spread. So normally on gold, I do $2 spreads, and usually you can pay about, between, depending on how volatile gold is at the time, usually around 75 cents is what you will pay for, a spread on gold, which gives you a chance to triple your money. So I'll take those all day long, and eventually you'll get the whole width of the spread, but that's not really what the point of it is. So now that I gave you kind of a little nugget there, something that you can really apply and make money with every week, take advantage of that. You can do it to the downside. If you think that Apple's going to break lower, let's say I think it's a little lower than 570, but you can do the 570 by 565 put spread when Apple is at 570, and look to get $1 on any kind of just trade down in Apple. Or if you think, let's say it opens at 565, you think it's going to flush down to 560, you put on the 565 by 560 call spread, and you do it for the closest expiration, generally speaking. If it's Thursday, then, well, obviously Friday you definitely have to be careful. But if it's Thursday going into Friday, unless if you're doing it purely for the time decay, it's usually not worth that overnight risk. So just keep that in mind. But anyways, really I don't have much more to talk about. What do you want to sell more euros? Buy more dollars? It's just that kind of market, in my opinion. And I think that what you're continue to look for is a dollar to move higher, euro move lower. Now equities moving lower. I do think at some point equities will be a buy, but I just don't think it's now. And if the price action proved to us today that it was worth increasing your exposure to the long side, the price action would have said it. The price action didn't say it, and now what we're looking for is, are the bears going to take control of that and slam this market? And the selling pressure will definitely speed up. And I assume you would see a break even on year at some point, which is 1260, which really that could happen in 3 days. So I wouldn't even think too much of it. So take care, have a good night. Be careful with your portfolio. Don't be overexposed to the long side. I would recommend being net short if that's your type of thing. If it's not, then cash is a great tool to have when the market's going down. So have a good night.